You're watching the NWR Resources Conference, November 2020. On the line, we have Lotus Resources. Lotus owns a 65% interest in the Kayelekera Uranium Project in Malawi. The project hosts a current resource of 37.5 million pounds U3O8 and has significant existing infrastructure, allowing for a rapid and low capital restart to production. Kayelekera historically produced around 11 million pounds of uranium between 2009 and 2014. On the line, we have Managing Director Edward Smirnov, who has significant international executive experience in the mining industry with a background in corporate development and strategy. He was Uranium One's CEO and led the financial transformation of the business, refinancing and paying down a debt of $500 million US, which helped lower the cash flow break-even price for the business while maintaining a global order book growth for the company. Edward has held various advisory positions, including the Royal Bank of Canada's Strategy and Transformation Group and KPMG's Corporate Finance Group, where he was integral in providing support to executive teams in the development and operation of their business across a range of industries, including natural resources and energy. Over to you, Edward, with your presentation.
Laura, thank you for hosting this conference, and thanks for such an extensive presentation of Lotus Resources. Well, to those who have joined us today, thank you for your interest in listening to the Lotus story. And as an opening, what I would like to mention is through uranium team, which I'm sure you all have been following throughout this year, which was one of the best years for uranium sector. There are a couple of questions that I typically being asked is why and how do we capitalize on the 9-year bear uranium market in the current environment, and why to invest in Lotus? Well, my answer has been fairly simple and straightforward. I believe that a proven producer can offer much more to investment community today, and investment in amalgamated moose pastures, which offers historical pounds in the ground, should be a second priority. And on the next slide, I would like to stop there for a second as per advice of my legal counsel. What we will be presenting you with today is a synopsis and a summary of our various public disclosure. We always encourage investors to go and look for our announcements that are available on our website. What I would like to do next, as per Laura's advice, to take 15 minutes of your time and walk you through thesis for investing in Lotus. And what I really believe is this new uranium cycle offers a great opportunity for our flagship operations, Kayelekera mine, to become a long-term supplier. And like many investors who have invested with us, I view uranium macro outlook fundamentally strong. Why invest in Lotus is certainly a key question for those who are attending this presentation today. And what I've seen through investment community so far is that Lotus is a standout investment opportunity for a number of reasons. First and foremost, it offers more when compared to producers and physical equities. It provides attractive valuation upside when compared to peers, and we are majority institutional owned, having strong cash position and optionality to tap into restricted cash balance. We have been fortunate to onboard experienced board members, and we have been fortunate to have a deep understanding of uranium cycle and uranium marketing, which certainly brings additional value to the company in getting it up into production. But most and foremost, the Kayelekera mine is a proven producer and has outstanding track record of production just less than 10 years ago. Kayelekera is one of few uranium mines built in the last bull market. It is a relatively new mining infrastructure which supplied more than 11 million pounds to nuclear customers globally. It had 5 years of commercial production, and we keep operations in the care and maintenance operations mode since 2014. We're new owners of this asset. We acquired this asset in March of this year, and we've maintained our mining license and supporting environmental compliance intact. Today, the mine offers more than 14 years of mine life, and it's significant compared to the rest of the operations that you may see in the space. But more importantly, it is a proven producer which stand out from other brownfield projects, and certainly to be one of the first to restart production. When we look at this set of data, we don't see ourselves simply as the fourth largest brownfield globally. We know what it takes to baseload a mine. Larger resource sizes require larger commitments from buyers, and installed capacity, which is much larger than 2 or 3 million pounds a year, requires long-term commitments from buyers. After all, we are convinced that Lotus offers a very strong path towards baseload contracting. Just by mathematics of it, baseloading 2.5 million pounds of annual production is going to take less time than baseloading 25 million pounds of annual production. And if we look at capital expenditure that is required to get brownfield projects back into production, we don't require hundreds of millions. We do not require $500 million like some of the late stage projects would typically do. We require 15 million. This is our current estimate to get back into production. And it certainly is competitive and is at the lower end of capital expenditure requirements by other mines. Now, Kayelekera has a very straightforward path to production, and our restart scoping study has supported restart being low capital and within 14 to 18 months period. When we look at the outcomes of our restart scoping study, it suggests and supports what we've committed to previously. It's a long-term operation with a mine life of up to 14 years. We're looking at C1 cash costs of around $33 per pound. And we certainly understand that raising capital in a tight environment is going to be challenging, and Kayelekera offers the lowest capital restart requirement compared to peers. More importantly, we all understand that restarting the mine requires additional marketing efforts, which we've successfully started. And baseloading the mine is our priority, along with the restart studies, which we will be focusing on in coming months. Now, if we look at attractive valuation upside compared to peers, Kayelekera has been a new entrant into the market, and we have been fortunate enough to see a strong share performance. And that share performance is coming out of capital markets quickly recognizing Kayelekera and certainly delivering on the promise of enterprise value to attributable resource misprice. If we look at where we stand today, we still view ourselves undervalued. There is strong support towards open pit operations we have in Malawi, being comparable with Paladin Energy's open pit operations in Namibia, and we're still seeing quite significant gap in that valuation. Now, what I would like to do for the next few minutes, I would like to draw your attention to uranium market. And I believe uranium market is poised for a significant re-rating. And if we look at this set of data, like in any other commodity, it's all about supply and demand. And it doesn't require rocket science education to reasonably guess the impact on uranium price when you have a deficit, which we've lived in for a few years now, and more deficit coming out of this balance between supply and demand. If you look what happened throughout 2020, it certainly has been a lot of supply discipline. We've seen major producers to leave their pounds in the ground and purchase supply on the spot market to deliver into their long-term contracts. We've seen a rationalization around supply production cuts from major producers in both major regions such as Canada and Kazakhstan. Those all are good signs. And if we look at where the uranium price has reflected all that supply discipline, we've seen more than 35% uranium price improvement this year, which is certainly supportive of trajectory in the uranium price, which is required to see new and idle capacity to get back into production. The other big component of the new cycle is the long-term procurement. If we look at utilities that have been purchasing uranium to supply the nuclear fuel needs, we're seeing a strong signal towards a new long-term contracting cycle. That cycle certainly is of importance to Kayelekera, and that would be a perfect timing for us to build our order book. If you look at US utilities and their coverage rates, they suggest that they will be getting back into long-term contracting fairly soon. And there are multiple reasons why long-term contracting has to resume. First and foremost, utilities would need to ensure they have long-term supply. And if we look at US utilities, the story is less aggressive than in US, but still on a significant downward trend. To supply into nuclear utilities, there is a long cycle. And before U308 is being sold, you need to ensure it is converted, enriched, and nuclear fuel pellets are produced. So nuclear utilities have been showing some interest in replenishing the long-term contracting, but we believe the market is yet to see additional procurement from nuclear utilities globally, where rates have been decreasing. And this decade seems to be the best timing to build long-term contracts. Now, if we look at production profile and deficit, this is where things get even more interesting in my view. We have seen a WNA forecast estimating undersupply to be between 30 and 60 million pounds. And that undersupply is coming between 4 and 8 years from now, which is really at the doorstep. And to me, that deficit is very significant. 30 to 60 million pounds, to give you a better sense, represent entire Kazakh production. And Kazakhstan today supplies more than 40% of global mine supply, and there is no time left to permit or build new mines, and there is no second Kazakhstan. So our position is very simple. This massive undersupply will need to come from multiple sources, and Kayelekera stands out very well to be ready to supply as deficit comes in. If we look at the production capacity, certainly Kayelekera sits in the tier 2 asset category, because in tier 1 you primarily have Kazakh operations and few other operations, tier 2 operations will require much higher pricing than pricing we are currently seeing. And in the last bull market, if we look at the deficit that has been 15 years ago, prices were at above $60 per pound. In fact, it's important to conclude that in the last deficit market, utilities have purchased more than 750 million pounds with prices above $60 per pound. And we are at Lotus planning to capture that long-term contracting cycle. We are planning to be part of market activity when it gets to procurement with utilities before we get into production. And today we've reopened industry discussions. We've reintroduced our project in new management to global utilities in North America, Europe, and Asia. And we will continue tapping into procurement plans by utilities so we can plan our restart accordingly. But more importantly, we know what it takes to baseload a mine. I personally have delivered production to utilities across the globe in North America, Europe, and Asia. And one of the lessons I learned is it certainly is unlike selling gold or silver, which you can deliver over an online trading system. In selling uranium, you would need to focus on constant discussions with the nuclear utilities and position yourself being able to supply into the contracting needs. And the good news about procurement that utilities are doing globally, they're looking at it from a long-term perspective, and they're looking for gaps in their procurement, and they're looking for those who can supply into those years where nuclear fuel will be needed. And the deficit certainly is supportive of the story to supply into nuclear reactors, and Kayelekera stands out with its production profile of 2 to 2.5 million pounds a year, given that average reactor fleet in the world requires around 2 to 5 million pounds of U3O8 annually. Now, one of the biggest areas where investors are excited about uranium sector is certainly its peak cycle valuation environment. And if we look back in the last bull market, we're certainly seeing quite a bit of correlation between uranium price increase and market capitalizations increases in the space. In fact, in the last bull market, Kayelekera was valued at more than $1 billion when it was part of Paladin Energy. And certainly, if you look at multiples, certain equities have provided the 10 to 20 times a return on investment as a result of peak cycle valuation. We're still far from seeing prices to get to level above $75 per pound or so, but we certainly know it is coming. It's more a question of when rather than if. Now, to conclude, I would like to say that the Lotus is well positioned for the next uranium cycle, and what we've done so far over the relatively short period of time, to me, is quite amazing. We managed to acquire the asset. We managed to improve our resources by 30%. We've managed to complete our scoping study, which was just March last year. And we managed to lay out plans for restart and our technical studies going forward, as well as we've reinitiated introductions of Kayelekera with former off-takers of the mine and new potential customers. We will continue updating the market as we progress. But to conclude, I would like to say that we believe there is a real window of opportunity for Kayelekera to become a long-term supplier this decade. Now, Laura, I would like to turn it over back to you to open up for a Q&A session. And those who have listened in, thank you for your attention.
Thank you so much, Edward. We've had a few questions come through from investors and potential investors. I have a question around offtake negotiations, which I believe started a few months ago. How are these negotiations progressing, given the uranium price has softened slightly since then?
Yes, we are committed to what we've promised. We've been introducing new management in the project and our restart and baseload contracting plans to utilities globally. We've spoken so far to about 20 utilities in North America, Europe, and Asia, and we will continue those discussions. If you would put discussions with utilities into a scale to describe where they stand, you basically have two major stages. First stage is origination, and the second stage is negotiations. We're certainly at the origination stage, given where the contractual rates stand today. And to come back on a point in terms of softening spot price dynamics, I think it's important to address that as well. For that question, Laura, if you look at spot market transaction volume, it's important to realize that spot market represents less than 10% of global mine supply and global nuclear procurement. Most of the contracting is done through long-term contracting, and that contracting is done through off-market negotiations or through on-market RFPs. And this is where you have to, as a supplier, be at front of the curve. You would need to introduce the project, your restart plans, and open up discussions so you can be invited to bid for certain volumes as nuclear utilities plan out their procurement. And that ties back very well with what we've started doing and will continue doing to reach a point where we have built a long-term order book to restart Kayelekera. So thank you, Laura, for that question. I'll turn it over back to you now.
Thank you so much, Edward. On that note of Kayelekera, you did say that the company was focusing on groups who had previously acquired Kayelekera. Have there been any other groups that have come into play?
Yes, it was logical for us to start discussions with those who supported the mine initially And I'm glad that we've put an announcement on that, and you can see that utilities that supported Kayelekera in the last cycle were utilities outside of Asia and North America, as well as nuclear buyers in Europe. Now, we've introduced ourselves to new teams within those utilities, and we didn't stop there. We continued with other utilities who we believed would be potentially interested in offtake agreements for this operation. So we've moved on from discussions with initial interested parties to a long list, and we will continue discussing with both groups where we can be of value. So
Thanks
thank you, Laura.
Edward. Thank you. Another question for you around care and maintenance costs for the company. How is Lotus going at reducing these care and maintenance costs?
Yes, we certainly have made a good progress. This year is going to be a year in transition. We're looking to reduce costs significantly. We announced that originally the costs were estimated to be by previous owner at around $5 million US, and that's the operating expense dollar amount. We've announced we would reduce operating expense to about $1.2, $1.4 million, and we're working tirelessly to achieve that objective. If you look at where the reductions in recent belt tightening for our operations come in from, first and foremost, that was staff reduction. We don't have 100 people at the site any longer. We have less than 20 people taking care of care and maintenance liabilities and the security of the operation. And we also have managed to renegotiate our diesel costs to run down our consumables expense. Going forward, we're looking to revisit other consumable contracts, and we're going to revisit our staffing needs, and we're going to revisit what potential optimizations we can do in terms of ensuring other services that are being provided as part of care and maintenance. It is on moving target, but we have that very strong objective to reduce our cost, because we know it will ensure we have secured cash for restart studies, which certainly where the funds should be going in the first place. Thank you, Laura.
Thank you. And lastly, I'd like to circle back to your comments around the uranium price in general. What uranium price would you expect to do an offtake agreement at, and for what time duration?
Yeah, it's a very complex question, and we're mindful of two major items here. First and foremost, we would be looking to preserve highest possible value for Kayelekera's production. And in the current lower price environment, certainly you would not be looking to place all of your production. If you look at our internal requirements, the logic is fairly simple. You need to ensure that first offtakes are signed at the price levels which are sufficient to cover full cost of production and return on restart capital that would need to be secured, and corporate expenditure costs as well. And later on, as we build our order book, we certainly would be, we hope, in a very different, higher price environment, and we'll be securing contracts at the different price levels. So it's going to be a work in progress to build an order book before to get into production. And to answer a question in terms of price requirement, well, there is no magic around it. If you look at tier 2 producers globally, I think that generally the cash costs is just a fraction of all in costs. What we are certainly mindful is we all have to find as an industry, as a supplier side, what is the break-even price? And I think industry is discovering that number as we speak, but our internal view is it certainly is above $60 per pound. And at that price level, contracts will find more appetite in the industry, and supply can be made. So I think that answers the question, Laura. But
yeah,
please,
thank you so much. Thanks for providing context around pricing there. That's really helpful. We did have a couple more questions that came through that we can't answer in the interest of time, but we will pass them on to the company Lotus Resources to answer in due course. Thank you so much, Edward, for joining us from Toronto today.
Laura, thank you for hosting this conference, and to those who have joined and asked questions today, thank you so much.